Hey everyone, Jack Duvall here. Got the second part of the Extravagant Emerging Market post that I put up on the Tarot Substack. So you need to read that first post first, but in short, I talk about my framework for understanding what's going on in the U.S. and U.S. financial markets by thinking of the United States as an emerging market country, which I call the extravagant emerging market. So here we go. Here's part two. There's going to be a lot of costs to running the extravagant emerging market playbook in the U.S. However, Trump is the master of the buy now, pay later school of management. And most of these costs will not be paid during the next 4 years. So what you're going to see is the debt's going to continue to go up. Musk is not going to have anything to do with this. And just so people understand, I'll take a small sidetrack here. If you think that congressional Republicans are going to do the right thing and, offer up their districts as tribute to Elon Musk to take spending cuts in their districts, you gotta get off whatever you're smoking, because that's insane. And of course, Democrats are not going to do that either. And Musk and Trump do not control the government checkbook. That's Congress. And they're just not going to do it. Congress is basically a ring of people who all agree to give the others something every time the budget comes around. That's the way it's going to be. That's the way it has been. It's not going to change. And, Trump, I think Musk is just going to be a distraction to everybody. Anyway, that's the sidebar there. Sorry for that. But how about some numbers? The non-discretionary, non-defense part of the U.S. budget, $600 billion a year. Now, I know that sounds big, but it's nothing. There's no way to get $2 trillion a year in savings from $600 billion of spending. You could cut it all to zero. You're not going to get $2 trillion. So it's just insane. I wrote up this whole thing. There's a link to it in this post. You should go read it if you're interested in it. In the current post, I have a chart of the U.S. government total public debt outstanding. It goes from zero to basically zero from 1900 to 1970. Then we get Nixon taking down the gold standard, taking us off the gold standard, and the debt explodes upward in an exponential fashion. It looks like an Elon Musk rocket launch, kind of, to keep that theme going. So I'm not saying the gold standard was a bad thing or a good thing, but I'm just observing. So, hey, the primary cost of this whole emerging market playbook is going to be inflation. So hot money is going to flow into the U.S. That's going to increase. And prices of everything are going to go up, especially labor. That's what you call inflation, a general rise in prices. And that's been going on. It's going to continue going on. It's going to accelerate. Now, we've had a strong dollar. That's not going to offset all this. It'll offset a little of it, maybe. But don't expect that to really help out. And of course, in the long run, for the Trump administration, which is, I don't know, three months, maybe long run for them, they're going to let the dollar go. They're going to let the dollar depreciate. That's 100% lock. That is the plan. It's just a question of when we get it. So anyway, some other costs, environmental costs, could be large. And of course, those are realized well after the fact. Dealing with inflation or environmental damage and changing weather systems and patterns, this is wildly expensive, and it's inflationary. And I know, look, if you don't trust a neo-Trotskyite like me, just ask the insurers. You can't get homeowners insurance in large parts of California and Florida, and that's coming to other states right now as I'm filming this. And the insurance companies, they're run by a bunch of pinko commies, but they do deal in these things called numbers. So it's a real deal, and it's going to be very expensive to deal with. And I also noticed that these red states that are, by the way, welfare queens, because they get a lot more from the federal government than they pay in taxes. They don't ever mention that, but I noticed they only stop bad-mouthing the federal government when they need federal disaster aid. Anyway, again, just facts. So foreign influence in the U.S., that's another cost that could be very high. We've already seen this. I went through it, how you can make a direct and basically cash transfer to Donald Trump by making an investment in the World Liberty financial token that he's got, and people have done that already. I wrote that up. You can read about it. So look, if an individual or a company makes a big investment in the U.S. or a direct transfer to Trump through the World Liberty financial token, they may have a big say in U.S. policy, which, by the way, is consistent with Trump's self-image of himself as a deal maker. But that's going to be expensive because who's going to pay for that? U.S. citizens. That's who's going to pay for it. So anyway, and emerging market countries selling parts of them off, that's EM 101. Okay, and that's a cause and an effect of investment booms. Again, just facts, just keeping it real here. So what are the investment implications? That's the real question. So history teaches us that once an emerging market country gets strapped onto the growth rocket, it's got to keep going. It's like a shark, got to keep moving forward. Once it stops, the whole thing goes bad. The gears go into reverse. It implodes, panic, capital flight ensues, currency collapses, interest rates skyrocket, investors get wiped out quickly because all of a sudden they lose a multi-front war of asset and currency depreciation at the same time. Now, sometimes the gates come down, investors can't even get their capital out at all. And if and when they can get their money out, it's like a decade or more for them to come back. So, there's really only one question then for investors: when will this insanity stop? And by insanity, I mean the fact that every last asset on the planet and in the U.S., except for commercial real estate, is at ridiculously high levels that are unjustifiable by any historical standard, except for this one confounding fact, and that's that the U.S. has taken a whole of government approach to pumping up asset prices. And by the way, most other governments are involved with the same project. So while history is replete with examples of mercantilist policies that promote exports and dirigiste policies that support favored industries, I'm completely unaware of governments deliberately trying to pump up financial markets, including speculative markets such as cryptocurrencies. For instance, the Dutch government was not involved with, encouraging the public to buy tulips in the 1630s. Now, I know there's been speculative manias that are certainly kicked off by changes in government policies. That's different. Okay, that's, a tax policy gets changed and people say that's really great and they rush in. I'm talking about the government's active participation in trying to pump your bags. That's a much different deal, but that's what we got going on here. So we kind of have government mandated asset appreciation. As I've written before, the U.S. government has, through a variety of policies, set up an economy that's heavily dependent on rising asset prices. So everybody's got a vested interest in those asset prices continuing to rise. Now, this is paid for with debt and a debasement of the U.S. dollar. And if you want the TLDR, it's basically this. You increase the money supply by, let's say, 7% a year, and you get 11% annual stock market appreciation. So now, is that a good trade? Well, if you're in the top 1% and you're asset heavy and you're inflation remote, hell yeah, that's a good trade. You'll take that all day. Now, if you're not in the 1%, it's a bad deal because you just eat that inflation sandwich and you don't get much in asset appreciation. So that's a problem. And that's why we've got populism on the rise here, because people are sick of that. But we're going to get more of it. So expect more populism. But what this does is it turns the stock market into a utility. But instead of providing a steady stream of water or electricity, the stock market provides a steady stream of investment returns. Now, others have had this observation before me, so this is not something that I've come up with, but it fits into my framework of the U.S. as an emerging market. So the mechanism is very simple here. You have retirement savings and 401ks and RIA accounts, as well as individual accounts. But they funnel cash to investment managers, which, due to fiduciary laws, make sure that a lot of that gets allocated primarily into the S&P 500 index. Now, they don't want you to know this, but that's an actively managed index. They rebalance it every quarter, and more of those dollars get put into the top largest U.S. champions. And then you have this self-reinforcing pattern. Because of the momentum-based algo that is the S&P 500. And just to explain that, if a stock goes up in price, it becomes a bigger portion of the S&P 500, and then the index buys more of it, and then it goes up in price, and then it becomes a bigger percentage of the S&P 500, and then it gets rebalanced higher, and it just keeps spiraling up like that. That's how the S&P 500 is actively managed. And it results in a Ponzi type of self-reinforcing rising prices. And it's worked for a long time. I think it's going to continue to work. Now, that's the old kind of default that's been around for 15 years, let's say. The new default with Trump is that you have these new policies, such as a potential strategic national Bitcoin reserve, where the U.S. government would actually buy speculative assets. So that's a horse of a different feather right there. But that's part of life in the U.S. as an emerging market. Thanks for listening.